14%. That's how much Intuitive Surgical fell. In the session right after, it beat revenue and beat earnings. It didn't drift. It gapped straight down from 402 to 365 overnight. What's up, guys? Coach B here. This is the breakdown. Today, it's Intuitive Surgical, ticker ISRG. Quick reminder up front, this is education, not financial advice. I'm not telling you to buy or sell anything. Do your own research. Real quick, if you don't know the name, Intuitive Surgical makes the Da Vinci surgical robots, the machines hospitals use for robotic-assisted procedures. It's priced like a growth stock, and that's going to matter in a minute. Look at the whole month first. Coming off a July 7th high of 443.84, the stock had already round-tripped down to a low of 344.55 by July 17th. Top to bottom, that's over $99, about 22% over 8 trading sessions, and it was choppy even before earnings. It closed at 407.12 on July 13th, dropped to 379.50 on July the 14th, then clawed back to 402.33 by the close on July 16th, the same day earnings came out after the bell. Then the gap, it opened the next morning at 365.03, straight down from that 402.33 close. From there, it bled a little further to a low of 344.55 and closed the day at 345.42, down 14.14% on 11.5 million shares, about 6.4 times a normal day for this stock. Now, here's the part that makes this weird. Revenue came in at $2.89 billion, up 19% year over year, beating the roughly $2.81 billion Wall Street wanted. Non-GAAP earnings, $2.80 a share, up from $2.19 a year ago, beating the $2.48 estimate by about 13%. GAAP net income was $818 million, $2.29 a share, up from $658 million and $1.81 a year ago. Every one of those numbers went up. The actual business grew too. Worldwide procedures, Da Vinci, plus their newer Ion platform combined, up about 16%. Da Vinci alone up about 15%. Ion up 36%. They placed 468 new Da Vinci systems in the quarter, 246 of those the newest Da Vinci 5, plus 55 Ion systems. The installed base is now 11,710 Da Vinci systems and 1,096 Ion systems out in hospitals running procedures every day. And they didn't just protect their margins, they raised the outlook. Adjusted gross margin guidance moved up to 68 to 69%, from 67.5 to 68.5. Quick bit of my own math here. Annualized this quarter's 280 non-GAAP number, and this stock is trading around 31 times earnings, even after a 14% haircut. That's still a rich growth price multiple, and that's exactly why this move happened. Think about it like this. If a stock trades at 15 times earnings, next year's growth estimate slipping from 15% to 12% barely moves the math. But if a stock trades at 30 times earnings, that whole premium is a bet on growth staying high for years. Shave a few points off the growth number, and you're not just trimming one year's estimate, you're trimming the assumption underneath every year after it. That's why a small guidance trim can move an expensive stock a lot harder than it would move a cheap one. So here's the one line that actually did it. Full year Da Vinci procedure growth guidance maintained at 13.5 to 15.5%. Maintained, not raised. And on the call, they flagged that U.S. procedure growth is moderating down to around 12% year over year. Two things are behind that. One, patients are deferring what the company calls benign surgical categories, elective procedures people can put off. Two, the enhanced ACA tax credits are expiring, and some patients are losing the coverage that made an elective robotic procedure affordable in the first place. Now, you may have seen a headline pin this 14% drop on a Da Vinci recall. That's mixing up two different stories, and I want to be precise here because it matters. The real Da Vinci recalls on the books are from March, a Class 1 flagged early alert on Sureform 30 gray stapler reloads tied to 4 serious injuries and 1 death, and April, a Class 2 recall on an e-brake retainer pin, 454 units. Both of those happened months before this earnings report. Neither one is what the company or the guidance commentary tied this drop to. What actually moved the stock on July 17th was one line about next year's growth, not a device recall. Two levels are worth watching from here. 344.55, the low from the crash day, and 402.33, Thursday's close before the gap, the level you'd need to reclaim just to fill it. Nothing says either one happens. That's just what's sitting on the chart right now. All right, let's pull up the actual chain because this part's useful, not a pick. Underlying sits at 345.42. Look at the August 14th expiration, about 4 weeks out, right at the 345 strike, which is basically at the money. The 345 call is bid 1390, ask 1590. The 345 put is bid 1290, ask 14. Both legs right there, dead center of the board, and implied volatility on both sides is running around 37.5%. Elevated for this name because the market is still pricing an extra movement after a shock like this one. Add those two legs and you get the straddle. Call mid 1490, put mid 1345 for a combined 2835. On one contract, that's $2,835 to cover both directions through August 14th. What that price is really telling you, the options market is pricing about an 8.2% move up or down by that date. I'm not telling you which way. I'm telling you what the chain is pricing. One more real number off this chain. The biggest open interest on this expiration, 635 contracts, is sitting in the 345 put, right at the money. That's more than double the next biggest strike on this expiration. Here's the downside on a trade like that, because there's always a downside. You paid $28.35 for that straddle. If Intuitive Surgical just sits in a tight range through August, say between 320 and 370, that premium doesn't vanish all at once. It bleeds out a little every single day from theta, whether you're right about the range or not. You can be completely right that it stays calm and still lose money on a straddle because you paid for movement, and movement is exactly what didn't show up. So how would I actually think about a name like this? Not as a recall story, because that's not what happened. I'd think about it as a re-rate story, a company that's still growing, still beating, still expanding margin. That just told the market next year's growth engine is a notch softer than this year's. If you already own the shares, that's a time frame question. Are you in this for the next quarter or the next 5 years? If you're looking at options, the chain is telling you the market expects real movement over the next month, and that cuts both ways. There's always risk in everything. Let's recap, because this is the real lesson, not just an ISRG story. Beat revenue, beat earnings, raise the margin outlook. Fell 14% in a day anyway. A beat is measured against the past. The price you pay for a stock like this is measured against the future. When a stock carries a growth multiple, the guidance line outranks the beat every single time. Quick reminder again, this is education, not financial advice. I'm not telling you to buy or sell anything. Do your own research. If this kind of breakdown is useful, subscribe and drop the next name you want me to look at in the comments. Good luck in the markets, no matter what stock you're into.